Ultimate wealth is found in wisdom alone.
Well, let's get started here. Let's jump right in.
Let's
So
go.
for those who are here, welcome, Kim Rondeau and myself, Axiom Wealth Strategies. We're going to be going over today the 2024 retirement and tax threshold changes. Every year, everything gets a little bit of an adjustment. And so we're going to go over some of those things and kind of where some of those thresholds are. And so Kim, thank you for setting this up. And
Yep.
once again, if there's any questions, how can people go about asking a question?
You can just type your question on your screen. I will see it right away. And when Neil decides to take a breath, I will send him a nudge and I will ask that question. Also, if you don't feel your answer, if you don't get the right answers, not maybe right, but you don't get your answer that you're wanting, or you want to ask one privately, don't hesitate to send us an email or call.
Excellent. And I will back that up by saying that we're not tax advisors here. So as we kind of go into this data, this is just general, tax threshold data that people should know in the back of their minds, and that they could, maybe use for them, maybe use for themselves. But we're not tax advisors. This is not meant to be tax advice, but certainly any kind of financial planning is related to this sort of data. So with that, let's jump in. So I'm going to share my screen and we're going to go through a slide deck. Here we go. All right. So I mentioned Kim and myself. Now let's jump right in. Threshold. So I used this last time, but threshold has to do with the magnitude or intensity that must be exceeded for a certain reaction, phenomenon, result, or condition to occur or to be manifested. Also comes from thresh, as we think of, removing grain from the chaff, and to rub, to turn, to stamp with feet, to knock or beat, to take that flour, to take the fruit of the wheat out of the chaff, right? So hopefully with that, in a similar way that King David, built the first temple on the threshing floor, hopefully we'll be able to make some bread out of this threshing we're about to receive from the tax man. All right, so I already mentioned we're not tax advisors. This isn't meant to be personalized advice, as we have a lot of people that listen to this, some that aren't clients as well. We're going to be going over the 2024 income tax rates changes and a bunch of other things that are related to that. We're going to go over to the standard deduction change, child tax credit, gifting, state, etc., education credits, deductions, distribution changes, tax deadlines, just some of the general information we should all know as we all go to file our taxes for 2023. We're going to talk about retirement plan contribution limits and the changes there, including HSAs. That applies to just about every one of our saver clients. Social Security thresholds, provisional income brackets, FICA and Medicare tax thresholds, etc., Medicare premium thresholds. And then similar to what we did last year, where we talked a little bit about the Secure 2.0, we're going to go back to that because there were certain things that were passed in Secure. The Secure Act 2.0, again, part of that big omnibus bill that didn't apply in 2023, but do apply in 2024. So just some things to be aware of that have become relevant now that here we are, 2024, almost done with January already. Okay, so income tax brackets. Here they are. Single, head of household, married filing jointly. A lot of our clients are going to be in this married filing jointly or single bracket. So one of these two, they haven't changed. So it's not a significant change for this tax year. Also, if they do pass a new tax law, I'll just say this, it's not common. I think they did it maybe one time where it was retroactive, but what you see here will apply very likely for 2024. There could be some changes, but from what I've been reading and heard, the main thing that may change is the child tax credit or even tax payments. There's been some negotiation on exactly how that's going to work out. for this year, but this should be what we have for 2024. And all of these brackets went up slightly. So you've got your 12% bracket, 22, 24% bracket, 32, 35, 37. Again, this is the single. A lot of our clients are also here in this married filing jointly. So if you're in the 0 to 23, it's a 10%. Which really doesn't apply, honestly, because you have the standard deduction, which I will cover here in a second. But 12% bracket, this is an important one to know because oftentimes the long-term capital gains rate, which shows here, that's if you sell an asset that you've held for over a year. What is your long-term capital gains? And typically the 12% bracket and the 0% bracket, let's say for this joint, which is married filing jointly, is $94,050. So real close, so just over the 12% bracket here. But these two usually come into conjunction with one another. Also, if we're advising a client, most of the time if we're doing Roth conversions or things like that and they're in retirement, a lot of times we like to convert traditional IRA assets over to Roth IRA assets when the income is below this 12% bracket, because 12 to 22, and again, this is just the federal bracket, not the state bracket, but just the federal bracket. That's a big jump to go from 12 to 22. And so that's, there's some decisions that are often made in this 12 to 22% bracket, whether it's long-term capital gains. Sometimes that means like gain harvesting in a plan or selling something sequentially to fill that 12% bracket or the 0% bracket long-term capital gains. But it's somewhat important to know where these thresholds are, whether you're single or married. That 12 to 22 is a big one, and then 24 to 32 is also a big one. 22 to 24 is not hugely significant for most folks. And again, long-term capital gains rate, if you're under that 12% bracket, you pay 0. For joint filers, if you're over that, you're in the 15 up to 583. And sometimes people think that that's a big bracket too. Obviously 94,000 to 583 in the 15% federal bracket. That's a lot of range. But if you sold a piece of property, or sold, commercial property or your own home even, and you're over these numbers, you might find that you break into that 20% bracket because, homes have appreciated quite a bit over the last few decades. And so it may not be unreasonable to break into some of these higher long-term capital gains brackets. So, and then if your income is over, for say married filing jointly, over 250, you have the additional Medicare tax here on 3.8. So you add the 3.8 to this rate here if you're over these on income. All right. One other bracket, which we didn't cover this last year, this is the Oregon. So this is the Oregon state. So we just covered federal. Now we're looking at the Oregon brackets. And so not commonly talked about. And since most of our clients are here in Oregon, I thought I would cover this too. And this is similar, single filers versus joint filers, and where those tax brackets diverge from even what you'd have in the federal bracket. And so I mentioned the 22 to 24 is not as significant in the federal bracket, but it does happen here in the Oregon bracket around 250. So you go from 8.75 to 9.9, and then if you're over this on the state return, you may also incur a net investment income tax in there as well. So something else to be, to think about when you're doing conversions, etc. There's another little layer inside that 22 to 24 bracket, which is your state income bracket increase. Actually, let me just go back to this real quick. So this is combined effective rate. So this does show the federal brackets here too. So federal bracket and then combined effective bracket. So you can see if in Oregon, if you're over for a joint return over 731, you're paying over 50% of your income now in taxes.
Do you have time for a
Quite
question?
substantial. Yeah, let's this is a good time. Question.
Is Social Security still not taxed in Oregon?
We are going to go into that, so hold tight.
Okay.
But yeah, quick answer to that is my understanding is yes. I have no reason to believe that that's changed at all. But we're going to go into that here in a second.
Well, look at that.
Here we are at standard deductions, child tax credit. We've covered this for a few years now, and the standard deduction is becoming, quite large. You can see here for a married filing jointly, it's 29,200. So that means that amount was deducted as your standard deduction. If your itemized deductions don't exceed 29,200, then you're just going to take your standard deduction. So where this can play in with a lot of people, if you're thinking from a planning perspective here with your standard deduction, is that we have a lot of clients that give quite a bit of their income and maybe they're giving even their required minimum distribution away. That if your giving doesn't exceed this, in addition to your other itemized deductions, you're still under the standard deduction. So it can make some sense if you're, because that's a lot of money, 29,200 is your standard deduction. You've got to give a lot away to break that threshold, the 29,200, to have that gift or that other deduction actually be deductible to your income. And so just something to consider. One thing that we've been helping clients plan on this is potentially making a larger 1-year contribution to pass that threshold of 29,000 in order to get the deduction, and then take the standard deduction the next year. Single, if you're single, 14,600, and then if you have some ailments, blind or over 65, add an additional 1,550. You can see blind, over 65, unmarried, and not a surviving spouse, you get a little bit extra there too. There's still a child tax credit, which this is on the docket potentially to change for this tax year, 2024. So this may end up being a little bit different than what we see. So, and then another thing we'd like to cover is just the gifting or estate tax exclusion and credits. So the one that applies to a lot of our clients is this annual gifting limit. And so this means that if you're giving $18,000 or less, you don't have to file any tax report. That's just your gift exemption. And I've had this question come up a number of times last year, so maybe something that I haven't been clear, IRS doesn't make clear, and that's that it's per Social Security number. So that means, my wife and I can give money to our kid. I could give 18, Lindsay could give 18 for 36,000 to a single child, if that was what we chose to do. If that child is married, I could give my daughter and my son-in-law 18,000, and so could Lindsay. She could give 18,000 to both of those two because it's per Social Security number. So the number to keep in mind is 18,000. So education tax credits, deductions, and distributions. I wanted to spend a little more time, and we may end up actually doing like a full webinar on education planning and some of the tax credits that are out there. But every year, these thresholds for income, which affect what your maximum credit or deduction or distribution from certain types of plans are, each year these go up slightly. So right now, just think if you're married, filing a joint return, 160,000 is the number to look into for most of the larger tax credits. The American Opportunities Tax Credit, Lifetime Learning Tax Credits. There's a nuance to these. Some of these you can only take one per family. Some of you can take them one per kid. Some of them are only for undergrads. Some are from graduate school. But every year these thresholds go up, so it's nice to see these up in the 160 range, because that's gonna apply to most young families these days. So just something to keep in the back of your mind for where income should be or could be in order to get some of these credits, etc. Tax deadlines. So we should all kind of have these memorized by heart to some extent by now. We already passed the January 16th, and this is for your estimated tax for the fourth quarter of 2023 was due. April 15th for the tax filing deadline extension, October 15th. So if you are filing an extension, it goes out to October 15th. June 17th is when the second installment or estimated tax payments due, etc. So just some things to keep in mind. There are a number of other dates in here that apply to some of our clients. If you have a cash balance plan, that contribution has to be in before September 16th. So that needs to be in earlier. So, but if you have questions, most people that we work with are going to have their taxes filed before April 15th and are going to have contributions for the prior year already made prior to April 15th. IRA contributions, individual retirement plan contributions have to be made before April 15th. There's no extension that you have on individual retirement account contribution. So if you're making a 2023 IRA contribution, it has to be made before April 15th. Kim, any questions?
I have one.
Okay, great. Let's do it.
If a single person wants to gift to 4 children, how much can he gift per child? I feel like I'm in a math class and we have a story problem.
Yeah, that's a good question. Here's the answer. You can give as much as you want. The only problem is that you start running into certain thresholds. Let's see if we can go back to this. Certain generation skipping tax issues. If you're going to gift to a grandchild, let's say, or if you do give over the 18,000, so you can give 18,000 per child. You have 4 kids, 18, 18, 18, 18. Then if you're married, your spouse can also give 18, 18, 18, 18. That's a lot of money. So most of the time, that's going to achieve most clients' goals for giving without having to file any tax form. But if you do give over that, again, you could give more than 18. You have to file a tax form because you begin to eat into your estate exclusion through gifting more than that. So the answer is you can give more than 18, but most of the time it's 18 per social security number per gift. So 4 kids, and if you're married, right, take 18,000 times 8 is 2, 2, 2, 2. Yep. So it adds up to be quite a bit. Good question. Anything else there, Ken?
Nope, that's it so far.
All right, let's jump to retirement plan contribution limits. Now, this is the one we sent this out when these first came out. I think it was around November of last year. So we sent an email out with this specifically because so many clients that we have this applies to. And this is the contribution limits to retirement plans, specifically entity-sponsored plans. And so this, again, applies to anybody who is still saving and has a 401k, 403b, 457, Roth 401k, SEP, simple IRA, etc. These numbers went up for every employee to 23,000. So if you're an employee, you can now contribute 23,000. The amount that went up was not significant in my mind. It went up from 22,500 to 23, so it only went up $500. And the catch-up provision has remained the same, so it's still 7,500. So the thing though to change, and the reason to be on this and to listen to the reason that you're listening to this webinar, or you're listening to this presentation, is to make sure you're maximizing each of these things. And that sometimes if we don't go in and make these changes to change our contribution limits, and we're in a 50% tax bracket, you know, that's quite a bit of money really quickly that could be easily not paid to the tax man, at least not now, through a deferral, and you know, deferral into a retirement plan. So you can see some of these numbers have changed on what the defined contribution plan limit or base limit is. Defined benefit plan here, base limit max, 401k, 403b, 457, Roth 401k. These ones apply to most of our clients. We have a few clients that have simple IRAs, and you can see what those limits are here. IRAs. So if you're thinking of, if you need to max out a 401k, you know, you may not be able to make an IRA contribution, but we do often get the question of, okay, can I make a 401k contribution and a Roth IRA contribution? And the answer to that is yes, you can. And every year these numbers index a little bit. So here we are, Roth IRA. Your maximum across the board now has gone up. So it was 6,500 if you're under 50. Now it's 7,000. That's a big change as a percentage. That's a much larger change than what we saw in the 401k. So if you're making monthly contributions to max it out at 6,500, then we need to make that small change to get that difference made to max out for the year. The catch up, the 50 plus has also remained the same. So same thing with the 401k at 7,500. The catch up provision at 1,000 has also remained the same. So you stack these, so 1,000 plus 7,000 for 8,000 if you're over 50, or just 7,000 if you're under 50. Now, one good thing that's going to start this year if you're over 50 is that 1,000 will start to index over time too, and it hasn't for a long time. It's remained, your catch up remained at 1,000, and so starting this year, that's going to start indexing upwards. But as a percentage, $500 onto the 6,500 is a pretty large percentage increase in contribution. So if you're able to do that and it makes sense for your plan, then it'd be something to take advantage of. The Roth, this is probably the most common question we have from folks, that they're maxing out their 401k, they're doing all their savings there. Can they still do a Roth? Well, here's where the income bracket breaks down at. So if you're over 230 for married filing jointly, then there's a phase out from 230 to 240. If you're over 240, you can't do a Roth IRA contribution anymore. If you're single, the phase out now is at 146. Now, 2 years ago, it was 129. And so that is a pretty large increase, where I've sensed that, you know, some of our nurse clients, some that were actually scratching on the top of the Roth IRA contribution maximum for income, you know, are now fairly safe, I think, as that maximum has gone up for single filers to 146. But again, if you're over 161 as a single filer, you can't make the Roth IRA contribution anymore. You can make a traditional contribution. You can actually make those even if your income's higher than some of these limits. It just doesn't become deductible anymore. And then when you pull that money out, you have to file Form 8606, which is IRA cost basis. Not as common for us to have a client that makes a traditional IRA contribution in addition to their 401k. You know, maybe unless they're doing backdoor Roths where they contribute to a traditional, then convert it over to Roth through 8606. There are a number of rules there. So if you're interested in that, let's chat about it. But the pro rata rule, if you're interested in this and you want to look it up, look up the pro rata rule. And that keeps a lot of people from doing the backdoor Roth contribution to traditional. So, all right. Other tax qualified plans and their limits, HSA, Medicare deductibles. So HSA limits is also going up. And I've also heard there's been some discussion around really changing the HSA limit to be much more for families, which I think would be a wonderful thing to do. It would really help lessen the burden of, major health event, not only in that year that they have the health plan, but potentially later on down the way. But right now, for our clients who have, they have a family health plan through work, and they have an HSA, which we're a big fan of HSA. So there's two types, again, just real quick. Flexible spending account, that's not on the sheet. That's what money you have to spend each year. And then there's a health savings account. And inside that health savings account, a lot of times you can invest. So it's a very efficient way because it's pre-tax dollars, grows tax deferred and tax free. So it's the trifecta in that Venn diagram, that center block where they all intersect, all the tax benefits. Health savings accounts we're big fans of, although sometimes each year you've got to plan around what's going to happen health-wise, and if you're going to have a surgery or you expect a baby or these sorts of things. Certainly picking your health plan can make a big difference on your budgeting and on your financial plan. But we're a big fan of health savings accounts around here. And for you can see here your maximum deductible contribution is now $8,300, which is quite nice. And then there's also a catch-up provision on this at $1,000. So if you're over 55, you can do an additional $1,000 to your HSA. If you're individual, $4,150. So Medicare deductibles. So this is just what you have to pay for your Medicare Part B deductible. This indexes each year too. So those who are over 65 and on Medicare, this would be a number that you'd like to know. So your Part B deductible, Part A inpatient services deductible for the first 60 days of hospitalization. This is what you have to pay as your deductible. And then Part A deductible for days between 61 and 90 of hospitalization. You pay out of pocket $408 per day. And then over 90 days of hospitalization, $816 deductible per day. So most of the time, this is over 90 days is where we're planning on a long-term care type of an event. So these policies, Part A is not meant to be a long-term care policy, just as a note of planning. But so these index each year, and I wanted to put those out there as well. Okay, so this gets to our Social Security threshold. So the question earlier was, is Social Security not taxed in Oregon? Yes, that's my understanding still. I don't think that's changed at all. But there's actually certain income limits where you're in the federal 0% bracket for married filing jointly. This is for pretty lower income. We're talking provisional income here. And provisional income, let's define that real quick. I have that on the left side here. That's adjusted gross income, not including Social Security, plus tax exempt interest. So if you have municipal bonds or interest that's tax exempt, plus 50% of Social Security benefits. So it's a little bit of a complicated calculation to find out what provisional income is. But once you know what provisional income is, if it's in these brackets, you can see under 32,000 of provisional income, it's taxed at a 0% federal rate. If you're between, this is for married filing jointly, keep that in mind. Single filers are down here at 25,000 of provisional income. But married filing jointly between 32 and 44, it's taxed as taxable income up to 50%, and then meaning 50% of your Social Security benefit is taxed as taxable income. And if you're over 44, this would probably be most of our clients that are taking Social Security are going to be over 44,000. Only 85% of that income is taxed as taxable income. One other thing that applies to some clients that we have that are still working a little bit part-time here and there and have a little bit of income, and they're under their full retirement age, the FRA age, the 22,320. So what does that apply to? folks that took their Social Security early at 62, right? They're still working, and but they've taken their Social Security. They play a game. There's a game to be played there on only earning so much, because if you earn over that, your Social Security is reduced $1 for every $2 you earn above this limit. So this also went up slightly. Not as much as last year. Last year we saw a really big increase in this ability to work prior to your FRA age. So for many people who are taking Social Security, that was the 66 and 8 months or 66 and 10 months. Now it's closer to 67 for most benefit receivers. So between 62 and 67, that time frame, this retirement earnings exempt amount has indexed a little bit. So now it's $22,320. One other complexity for those that are just recently retired or that are retiring in their full retirement age year, so they're gonna turn 67 this year, there's a subsequent number that also indexes a little bit each year. And this is the amount that you can earn without having your Social Security reduced in your full retirement age year. A little bit complex, but just something to keep in mind that if you're retiring mid-year and you've earned up to that amount, this is just based on one question that has come up, is just on your Social Security number. So your spouse may still have a W-2, but just on that individual Social Security number in the year they turn 67, and you elect your benefit in that year, so you worked half the year, that's where this applies to, this $59,520. Any
We have another
questions?
question? Yes,
Yeah, go
I was
ahead.
just going to say, we have another question. Medicare supplements take care of those extra charges. Is that correct?
I'm not sure. I think, I'm not sure if you're referring to a deductible or Medicare supplement. My understanding is that it's covering things that Medicare doesn't typically cover or may not be under that umbrella. So you're getting that supplement policy to kind of fill in the gaps. Yeah, we're not covering that here really with regards to thresholds. But what is important here is, say, talking about where these Medicare deductible thresholds, which do increase each year. So each year they get set. And so this is money that you would be expected to pay out of pocket prior to your Part B and Part A coming into play. And so those change each year. So.
Okay. And if it's an insurance question, I think if they have questions on that, whoever their policyholder could answer that too.
Yep. All right, let's go to the next here. So this is Social Security thresholds for those that are still working. So this is also for our employers. When you look at what you're paying for the FICA tax, right? This is the amount that's withheld. These percentages haven't changed. The only number that I would say that really applies here, I put over here on the side, is this 168,600. So last year it was 160,200. And so for those that are earning, over 168, you're paying 6.2% of your income plus some other taxes in there too, up to 168 or up to the maximum taxable payable. So these thresholds go up a little bit. If somebody, is working, let's say they're making 200,000, they're paying that FICA tax all the way up to 168,600 for Social Security, that is. So that went up slightly. That's the most applicable thing. This I covered in the last slide, the full retirement age and where that limit was. So that changed slightly. Yeah, not much we can do here on this. This is these percentages have stayed the same. The only number that changes is what income, your tax for Social Security up to 168. Once you earn over 168, that's not taxed on the Social Security at least any longer. Medicare premium threshold. So we always are covering this when it comes to Roth conversions and making sure we don't, cross a threshold. And many of who have been on our past yearly tax threshold webinars know that we call this the true threshold, because like if you cross one of these things by a single dollar, you're threshed. You got threshed on that move, because it's not a phase in, really. It's like you break it by $1, then boom, you've got this new premium to pay. And so this is showing on a single and joint. So single in this column, joint, modified adjusted gross income. If your modified adjusted gross income crosses this threshold, then you enter into the next Medicare Part B premium and then Part D income adjustment. And so we did a chart on this. Each year we do this. Last year we compared it to, this should have been 2024, but these numbers are all relevant to 2024. So this was 2023, this is 2024. And what we look at here is just what actual surge charge you're paying in addition each year. So if you break this 103,000, if you make 103 as an individual in $1, then you go up across the board. Married filing jointly here, if you go up by $1 above 206,000 a year, then you're paying an additional $19,000 or $1,987.20 per couple per year. This can catch people off guard, guys, in that you sold your house 2 years ago, because the Medicare premium threshold is using your income for this year, 2024, from 2022. And so let's say you sold your home, you had a big increase in gross income because you had a large capital gain on that. It catches you in that, then you catch up to 2024 and they look back on your 2022 income, and then you've got to pay suddenly, maybe let's say you made 400,000 as a capital gain and you made some income as well. Boom, you're up here, and suddenly you find yourself, having to pay quite a surcharge. It's quite an additional premium on your Medicare because of that past event. And so something to think about. But also in a normal year, if we're going to do some conversions, or we're doing a conversion in the up to the 22% bracket or up to the 24% bracket for some, this is an additional, it's not a tax, but it is a tax, right? It's going to have to be paid for your Medicare premiums. So these numbers are important to know on where these thresholds are, because again, they are what I call a true threshold, where your taxes work where your first set of dollars are taxed at this lower rate, the next set of dollars are taxed at the 12% rate, the next set of dollars are taxed at the 22% rate. So if you cross from 22 to 24, it doesn't mean that your whole income is taxed at 24. Or if you go from 24 to 32, it doesn't mean all your income is suddenly taxed at a new threshold. It segments in up to that last dollar taxed at the highest rate. However, Medicare premium is a threshold where you cross the threshold by $1 and you got to pay that additional Medicare premium. So important to know for conversions, etc. All right, so main takeaways. These are things that we are bringing up with clients throughout the year. So we covered this, 12% bracket or higher. All the brackets are a little bit higher. So doing conversions, etc., which I have here, or doing some capital gain harvesting under the 0% long-term capital gains rate, etc. All these thresholds have come up a little bit. So Medicare premium thresholds and Roth IRA conversions, we talked about that. Max contributions to 401ks, 403bs, etc. Those contribution limits have all gone up. And for those that are still saving, I often say in this order, if I were to predict success for retirement savings rate is number 1, asset allocation is number 2, and then expenses that you're paying is number 3. So savings rate is important. So that's why we like to cover these and make sure that people are getting the maximum out of their employer-sponsored plans each year by making their full contributions there. Social Security cost of living adjustment has also gone up. So last year it was like 6.8. I think this year it's 3.2. So that's high. You know, when you think the last 20 years, I think it's averaged like 1.25 or 2. So it's still higher than it's been. So your Social Security is getting a bump this year. That's important to know as we do a conversion. We want to add up all these incomes that are coming in. We want to add up what your Social Security income is, and we want to add that little bit of increase. If you're on PERS, we have a number of clients that have PERS income, likely because PERS max is at 2%. So you get a cost of living adjustment at 2%. So you're probably going to get that as well. So if you're trying to figure out what that gross income, taxable income will be for 2024, to figure out what our conversion numbers might be, just keep in mind that Social Security cost of living went up. You likely get a cost of living adjustment on other pension plans. If you're PERS, it'll be 2% likely. All right.
Okay, we have a question.
Yeah, go ahead.
Is the COLA of the 3.2% for the current year, i.e. what will it show up in January of this year? Not looking forward to next year? Question mark.
Well, this 3.2% for cost of living adjustment is great. Yeah, you never know. It kind of depends on what inflation is, because that's what they're basing this off of. They base this off their best projection on what they think inflation will be averaged out over this year. And right now, I think we're 3.8. And so they're saying they're expecting inflation to come down below 3.2, certainly by June, right? And so who knows what it is? It's basically just try to keep these dollars coming in through Social Security strong. That's it, to help it keep pace so that, you know, your buying power is the same one year to the next. But, you know, it will be added. These increases are added to that taxable income number. So if we're trying to figure out, is there room in the 12% bracket, or is there room in the 22% bracket? You're adding up each of these incomes. If we need to extrapolate out what that 3.2% increase is going to do for gross income for the year, if we're trying to figure out what those conversions should be, and to be able to stay in those brackets. So, all right. I'm going to jump to a couple of the Secure 2.0 items. So we covered this again last year, but just kind of to reiterate some of the changes. The biggest one last year was that they changed the RMD age to 73. However, those that were 72 who had already started, they were still going to have to start taking RMDs. This applies to every one of our clients, and when they, you know, if they have a qualified account, when they're going to have to start taking money out of that account. So this gives a quick breakdown. If you're in these age bands, this is going to be your RMD age. There's not complete clarity on, will it go from 73 to 74? But if you're over 60, the plan now, or excuse me, if you were born later than 1960, your RMD age will be 75. A couple of things from last year. This was 2023. Honestly, a lot of the custodians that were not able to facilitate a simple IRA or SEP IRA in the Roth format. We were kind of chasing that down right toward the end of the year. You know, you could still potentially make a SEP contribution for 2023, but my understanding is the major custodians and that we deal with are not prepared to do this yet. But this was one of our major changes for 2023 that the custodians just haven't been able to adjust quickly enough yet. Yeah, this year, so starting in 2023, we're expecting the QCD, that's Qualified Charitable Distribution Index, you know, to start to index a little bit. Just something to keep in mind, meaning that it's been 100,000. but now we'll see that index with inflation. So my guess is if Social Security is expecting 3.2, it'd be $103,200. That'd be my estimation for what QCD contributions will be for 2024, the maximum. So this was from 2024. So this gets into the things that would become applicable for this year from the Secure 2.0 Act. So a couple of things that highlighted here in blue. This is the major thing we felt like changed and that will change for this year. And that major change is that you can take a 529 plan. That's the education funding plan, and you can convert those over to Roth. Now, a couple things. You can only convert up to the maximum. So we covered that earlier. The maximum, this was from last year, was 6,500. So this year it's 70 or 7,000. So you can convert 7,000 up to a maximum of 35,000. So, you know, if somebody's on the fence of whether or not they should do 529 plan or they do some other type of plan, we're a big fan of getting that tax benefit. It's one of these other things you can get a trifecta of some tax credit for our state sponsored plans, some tax-free growth, and tax-free liquidation. And so I'm a big fan of the 529 plan still. And then this is just that one last thing that sometimes it holds people up, that, hey, what if they don't ever use their 529 plan? Well, now you can convert it over to Roth over a few years and up to 35,000. So that becomes applicable here in 2024. So we talked about this. So plan distribution rules are eliminated for Roth, 401k, 403b, etc. That starts this year. So elective deferrals, I mentioned the catch-up contributions must be Roth. So there's they're talking about it as a super catch-up provision. So some of these rules are going to be changing for if you're over 60 and making the super catch-up provision, those have to be Roth, depending on where your income is. Early withdrawal penalty exceptions. So they've been changing these for emergencies because so many, you know, folks pull money from their 401k and pay a lot of money in taxes. So they're limiting some of those. And then the simple IRA non-elective contribution limits. So simple IRA used to always be participatory, meaning it was a matching contribution. Non-elective contributions means they're just going to do 3%, or they're just going to do, the employer's going to do 5%, whether or not the employee participates or not. And so those limits have also changed for the simple IRA. This may apply to a few like very small employers, a few or no employees that still want to be able to do a larger than 25% of salary. That this could be applicable to them. All right, 2020 Secure 2024 continued. I'm going to try to be quick here, so we can maybe be able to answer a few questions. But this was a major change. It's something that I haven't run into yet, but it's something to that would be a rare event. But it's the surviving spouse election to be treated as an employee that changed. Now, you might think, where would that come into play? Well, it has to do with a spouse receiving their deceased husband or wife, their retirement account. They could be elected to be treated as like a beneficiary, a qualified beneficiary, rather than bring it into their own account. And you might say, well, where would that take effect? If there was a large age difference and one spouse, the younger spouse passes away, rather than bringing it into the older spouse's retirement account, which is normal, that's what we normally do, we consolidate those. It may be advantage to keep the account in the deceased spouse's name so that the RMD doesn't kick in until later, because it's effectively like a beneficiary IRA there. So there's some rules around that still, You know, I haven't had to deal with it yet, so I don't have it pinpointed down exactly. But that was a change that made some difference that comes into play only in this year in 2024. And then being able to make a mid-year simple IRA to 401k plan conversion that wasn't available in 2023. That's a big deal. So if you're a small employer and you've been considering doing a 401k, which we help people go and set up 401ks too, this has been something that's really kept them from doing it. You make a contribution 1 year to a simple IRA or another employer plan, and then you can't make a conversion until the next year. Well, this makes complete sense. There's no reason not to allow them to go to a 401k. And so that starts this year too, being able to make, change your plan mid-year. So that is it for the presentation. So,
Well, thank you, Neil.
yeah.
Good job.
Kim, do we have any other questions? Have we had anybody?
No other questions right now. Would like to remind everybody, if you do have questions, don't hesitate. You can always email us or call us. So that's that. Happy New Year to everybody.
Happy New Year, and hopefully that threshing wasn't as bad as you thought. Hopefully we can go make some bread with our freshly harvested grain.
There you go. Exactly. We thank everybody for attending. It was great.
Yep. Thank you, Kim.
Good questions.
Thanks, everybody. All right. Bye.